Hey there, Colin Exelby, Certified Financial Planner here, and you may notice my background looks a little bit different. This is my home office. I run a virtual business helping clients around the country, and that means I can work from anywhere as long as I have Wi-Fi. Whoa. Oh man! What I didn't expect is that my kids would be here with me throughout the day. So we're trying to figure out how to manage through this, probably like a lot of you out there. But they're doing a pretty good job. They're happy to say hi, and they're being quiet for the most part, right? You enjoy being home with us?
Mm-hmm.
Oh, that good? Okay. See you later.
Bye!
You close the door?
For you.
Thank you. Well, this added complexity, I wasn't anticipating that. But I'm managing, and I hope that you are too. So, if I will say this, if I hear the words, "we are in uncharted territory," one more time, I might throw up. And the crazy thing is, we are. The volatility in the financial markets, they have many investors, even the most level-headed ones, unnerved here. So stay with me and I'll walk you through my thoughts on where we stand now and where we may potentially be headed. COVID-19, which started in China and took months to spread around the world, has made it to the U.S. shores, and we're now in an unprecedented lockdown. As we try to slow this virus to keep from overburdening our hospitals and doctors, we're grinding the U.S. economy into a contraction. And due to the extreme uncertainty involved, one could easily make the case for two wildly different outcomes. Let me outline them for you. So here's the bullish case. The bullish case. The bullish case. Yeah, that makes sense. The bullish case. Following the horrible experience in Italy, countries around the world take the threat seriously. Tests become plentiful. Gatherings of more than 25 people are canceled, and citizens self-quarantine. And I'll tell you this, if you're out there and you're not minding any of this stuff, please do us all a favor and try to keep your distance, try to self-quarantine. You know, you're doing it for other people, not yourself. So hopefully you'll adhere to this stuff. Governments around the world, they coordinate massive fiscal and monetary and healthcare policies to address the escalating situation. A payroll tax holiday is invoked for both employees and employers, which is similar to having a check just given to you by the government. Federal Reserve banks take interest rates to zero and support lending wherever possible. The infection rate peaks in March, and we're already seeing the number of new infections in China drop to the single digits for the first time since reporting began back in mid-January. And by spreading out the number of cases through social distancing, hospitals are able to manage the patient load, and the death totals are mild. Now, we don't like any loss of life, but if we are able to keep the death totals down, obviously that would be great. Treatments are developed to increase recovery times, vaccines are distributed, and global immunity prevents any major future outbreaks. Economies and stock markets around the world rebound with a ferocity not seen in years. Bankruptcies are avoided. Most small businesses make it through. Restaurants and bars, they reopen to jubilant patrons, and financial markets hit new highs by year end. And this is looked back on as a really scary couple months that turned out to be a great opportunity for investors that came and went. I'm going to grab a little sip here of bubbly. This stuff is great, this bubbly sparkling water. I don't know, my wife got this, and yeah, we're drinking at the office now too. This is good stuff. Okay, so what about the bear case? What's kind of in my head of what could be the worst case scenario? What I'm thinking is that some countries around the world take this threat seriously, including the United States, but it's too late, and the virus has spread too far. And many in the global population ignore those suggestions to self-quarantine. Please don't do that. Cases go exponential because it spreads so easily, and hospitals are overwhelmed and unable to manage the patient load. Death totals soar way beyond expectations. As cases spread to athletes and entertainers and public officials, a panic ensues. Most people end up knowing a friend or family member that dies from the virus. Treatments are ineffective at improving recoveries. Vaccine attempts continually fail. And the experiments with social distancing fail to slow the spread of this thing. Governments try to implement various financial and social stimulus policies, but they don't work either. The U.S. stock market declines 40%, taking it back to historically average valuations. Oil, real estate, gold, and many other financial assets fall in tandem. But the warm summer brings some relief from the virus, and economies improve and markets stabilize. People begin to think that the worst is past. However, by fall, COVID-19 reemerges. Previously expected to be a short-term problem, economies and markets are impacted over the course of years, not the months expected. And the social mood of most people around the world turns to fear and depression. Markets decline to valuation levels not seen since the bottom of the global financial crisis in 2008. Another 30% down. 60% down from the peak in early 2020 before finally bottoming out in 2022, 2 years later. Now, which scenario is more likely to occur? I have no idea, and neither does anyone else. I have a very cloudy crystal ball to begin with, but especially so when it comes to biological threats. The reality is that likely the outcome that we're going to have is going to be somewhere in the middle. But because each scenario is so different, many investors are just wondering what they should do. Now, everyone's financial situation and risk tolerance is different, but for many of us, the best course of action is nothing. Yep, because you are as prepared as you could be. Global markets are experiencing large moves up and down virtually every day. The swiftness of this move has traders and investors on edge. U.S. stocks declined enough at the market's open, 7%, triggering circuit breakers that paused trading multiple times so far this month. Investors all over social media are panicking because they don't have a plan. But you do. You created a balanced portfolio of systems and rules-based investment processes that can help you manage the emotions of greed and fear. You're not investing from gut instinct. Proper risk management and asset allocation has helped to minimize the damage. You put in the work over the past decade. You've listened in our investment and financial planning reviews. You've watched my videos on See the Forest Through the Trees YouTube page. And after this video, make sure you subscribe there so you know when a new one is added. You subscribe to the blog, seetheforestthroughgetrees.com, to stay up to date on outside-the-box ideas and financial planning techniques. And you follow the Celestial Wealth Facebook page so you can see the live videos that are posted up there with new content. You've even subscribed to the periodic market letter. Bottom line, you have a plan. And take note, each person's plan is different and applies to their specific financial situation and risk tolerance, but it follows the same fundamentals. You had a plan so that when it hits the fan, and I'm not going to swear, so you probably know what that word is I was going to say, but when it hits the fan like it is now, you're as prepared as you could be. Your friends and colleagues, they might be freaking out, but you're not. They might be sending you text messages late at night wondering what you think. But you know this too will pass. You already know that big daily stock market moves of 5 to 10%, actually they're pretty normal, and they generally cluster together. In addition, you know that while diversification cannot ensure investment success, historically it sure does help. You're mentally prepared for a time when asset prices took a dive because you know that markets don't rise forever. Corrections, or cleanses as I like to call them, they allow for a reset of investor expectations and lower valuations. And lower valuations generally lead towards higher returns in the future. You learn to think long term, over years and decades, rather than the short attention span of months, weeks, or days. Now let's say you did all this. I give yourself a pat on the back because you're about as prepared as you could be for this event. You can sit back, read a good book, turn off the television, and do nothing. And generally that's what I plan to do for the most part. Sure, I've waited for a correction to pick up bargains where they make sense, but they must fit within my plan. You should do the same. Now, I know it's hard to sit on your hands, do nothing, when it seems like you really should be doing a whole lot, but what I'll say is, don't pay the stupid tax. Look, we all make dumb decisions, and they impact our financial lives. Not preparing for unforeseen risks, not having access to cash and liquidity, thinking short term, allowing our emotions to get the best of ourselves, and not having a plan. But you learn from that. And you've minimized those mistakes, that tax on stupid as I call it. And now we're as prepared as we ever can be so that we don't pay the tax on stupid behavior. Now I know it's hard to resist the temptation. That temptation I'm talking about, to check your account balance online, to flip on CNBC and Yahoo Finance every day to see what's happening. But in this market, this illustrates the beauty of a well-diversified global portfolio across stocks and bonds, as well as assets that do well in inflationary periods, along with tilts towards value and momentum investing. So if the markets turn on a dime and rip higher, I'll be okay too. And having trend following strategies that are rules based and unemotional, that can help too. Oh, and I almost forgot. We have to make sure that we rebalance the portfolio to keep tilting more and more to the cheaper assets so that when they turn, you can participate. The thing about big market dislocations is they create massive stress, emotional, financial, marital, and many other kinds I can't even think of. I'm trying my best to manage the level of stress, and I've said this a couple times in the past. This app called Calm, which is available on Apple TV, you can get it on your phone. It's a great app for calming yourself down, meditation. We did it as a family the other night. We're going to be doing it going forward just to kind of keep everybody on a level head. But these stresses that I'm talking about, they can lead people to act bananas crazy with their money. The dash for cash, it's real. Those that didn't plan for a rainy day, they have a problem. Those that had all of their savings in risk assets, they have a problem. But that's not you. If you're retired, you set aside years' worth of expenses in less volatile assets and cash management. If you're still working, you maintain access to credit lines and set aside savings for the unknown. Let that be your opportunity and not your downfall. Try not to burden yourself with the requirement of perfect timing for adding to your portfolio during this sell-off. If you think that you're going to be able to time the bottom and put all of your dry powder to work that week, you may end up missing it completely. For example, let's say you were a prudent investor. You didn't believe the hype and you amassed a stockpile of dry powder, cash ready for crisis investing. Well, when do you put it to work? Of course, that's a really hard question to answer in real time. It's really easy when you look back, really hard in real time. After all, if markets rebound really quickly, the answer is right now. But if the coronavirus is destined to hit us with a second wave in the fall and markets drop another 30%, then an investment today could look premature, quite painful. Again, no one has a crystal ball, especially me, and no one can time the markets perfectly, so stop making that demand on yourself. Perhaps the better approach is simply considering at what levels of a pullback you'd feel it's appropriate to deploy your cash. Note, I didn't write feel comfortable, but appropriate, because it's going to feel pretty scary, I bet, to put money to work at any time because of the volatility that's involved in the market right now. But now might be worthy of one of your pieces of capital. Down another 10% from here, it might warrant a second piece of your capital, and so on. The answer is specific to you, the amount of capital you had to invest, and your belief about how our world and the markets are going to respond to this situation. For others, they'll just continue to dollar cost average in their 401k. Regardless, the appropriate question to ask yourself isn't, is this the bottom or is the bottom close? But rather, in 5 or 10 years from now, is there a good chance I'll be happy that I invested at this level? My guess is yes. I really hope this helps, and as always, we're here for our clients if you want to talk. But likely you don't need to, because you prepared for this. If you know someone who could benefit from this video, please share it with them. There's a lot of people out there in this country without a coach, or without a coach who's proactive and has a plan. I want to help people in this crisis as much as I can. I feel that the best way that I can do that is to share my knowledge and my experience. I've been in the business of giving financial advice for 20 years. This is my third major financial crisis, from the technology bubble that busted to the housing and financial crisis to now this one. I'm a fully licensed, certified financial planner professional. In my combined firms, Celestial Wealth and Armstrong Dixon, we have 6 CFPs working together to manage through this. Make sure you follow the hashtags Be Clear, Get Clear, and Survive to the Other Side. And that's survive with the number 2 to the other side. We're going to be using those hashtags as we continue to put content out to help manage the crisis. Stay safe, stay healthy. We'll get through this, and I will talk to you again. Thank you so much for watching my video. I want to be your source for financial planning strategies. I know there's tons of information out there. We're scouring Google, hoping to find information that's pertinent to our situation, but we never know. There's so much information out there now, and I want my team to be your resource. So make sure you subscribe here. Anytime there's a new video released, we want it to ping and let you know so you can check it out. Make sure you check out the blog, seetheforestthroughthetrees.com, a lifestyle blog that does a tremendous job of bringing curated content from not only us but other people. Thanks again for following us, and we look forward to seeing you again.